Okay, before I begin this week, let me make a comment about the comments section. This week has been a rough week. I think there were 300 comments, and over 200 of them were about Bitcoin, and you got to contact this person for Bitcoin, and hey, contact me on WhatsApp. Let's talk on WhatsApp. Just a bunch of crypto scammers. I've never seen it this bad in this last week. The amount of blocking that I have to do. And that one person is back again that wants to use my logo. So they have, you see the M logo and it says, thanks for the comment, let's connect. And it has a WhatsApp number with a whole bunch of circles. And the number is in there. This loser keeps coming back. I keep blocking this loser. He keeps making new comments. Listen, I will never, ever ask you to contact me on any platform ever. If I miss one of these comments and it looks like me, say, oh, that's his logo, it must be him, and you're connecting with somebody and they're telling you about this crypto investment and you think it's me and you have this level of trust, it's not me. I will never, ever ask you to do that. Which brings up a problem here. The comment section is so difficult to manage because just the number of crypto scammers that are showing up these days, it's like, for every legitimate comment, there are 2 fraud comments, and you got to keep your comment section clean. I think it's incumbent on every provider or every content provider to keep their comment section clean. It's getting to the point where I'm contemplating turning off comments. And this way here, the problem is over. If I do turn off comments, you can leave your comment below the video on what I'm about to say here. If I do turn off comments, I will open a Discord chat group where you would then have to have permission to enter the group. And as you're watching the video, you can then leave your comments in the Discord group, and I'll still do the Q&A session, but at least all of those scumbags and losers can't show up in the Discord group because YouTube's not doing a damn thing about this. You report them every single time, you delete them and report them, and nothing. And I'm not the only one having trouble with this. YouTube risks ruining the one thing that heightens engagement on their platform, which is the comment section. If they don't start policing their comment section and getting rid of these people, it's going to get ugly. What I wish YouTube would have is a private, is have a comment section, but make it private such that rather than me go to Discord to get this done, I can just say, hey, listen, if you want to be in the chat section, just ask me for permission. I let you in. If you abuse it, I kick you out, and then it's over, right? But the way it is right now with the bots, because it is the bots that are leaving all of these comments, you can't beat them. Anyways, let me know what you think about that. But there's just all of these. It's just a swamp in the comment section if you don't continually monitor all of this garbage that is left there. Tell me what you think in the comment section. Let's jump in. Okay, time for questions. Why is the yield on short-term treasury bills usually less than the federal funds rate? Well, I'm going to cross out the word usually, and I'm going to say now. It's at this point in time. Why is it now less than the federal funds rate? And the 1 month is sitting back here. The Fed funds rate is 3 to 3.25. The 1 month is below 3. The 2 month is in between the 2, and the 3 month is higher than the upper bound. What the 3 to 3.25 means, it's for banks that have extra funds or that need extra funds. If they have extra funds, they're going to lend it out overnight. If there are no takers and they have to take less than 3% to lend it out, they can always go to the Fed and get 3%. If they need to borrow money, and they have to pay a higher rate than 3.25, they can always go to the Fed and get 3.25. That is how the Fed targets the overnight rate, by saying, we'll lend money at 3.25 and we'll borrow money at 3, so there's no need going anywhere else. The rest of the market that can't access Fed funding has to lend and borrow in the public market. So if I have extra money and I'm a corporation, and I have payroll at the end of the month, let's say. Well, I'm not just going to let the cash sit in a bank account. I'm going to put it in something that earns money. So I'm going to try to find some treasury out there that has maybe 26 days left or 25 days left. I'm going to try to get into something. But everyone's trying to get into something. So it pushes the price up, which pushes the return down. Why take this return? Why not just grab the 3-month return and sell it in 27 days? The longer the maturity you get, the greater the duration, meaning the interest rate sensitivity. So when interest rates are super, super volatile, as they are now, money tries to be as young as possible. In other words, the lowest possible maturity. So if you needed to invest money for 4 days, you would like to find a 4-day security because you want no price risk. You just want return. So that's why the 1 month is lower than the lower end here, because this is everyone who can't access this 3%, but is not just going to let money sit idle. So you may as well get something for it. But if interest rates were less volatile, if the short end of the curve were very, very stable, you would find that there'd be more money moving into the 3-month, maybe even the 6-month, if we expect interest rates to be stable for a period of time. Next, 2 questions here. With a shift of manufacturers to Mexico with a potential, it hasn't happened yet, but the thinking is that is the next destination for North American supply chains. What has caused or changed? What has changed or caused the change? Well, China issues are a big one, and China seems to be more willing to, saddle up to Russia and help Russia out than we would like. China has eyes on Taiwan, and the West doesn't seem to want that. The West has problems with China. China has problems with the West. Without making any value statement, let's just make a statement of fact, is that they have cultures and ideologies in which they just disagree with each other on certain things. So why not reshore things to Mexico, where you can get actually cheaper labor and you increase the security of your supply channel? So that's why I say potential. If you think about it, Mexico is always closer to the U.S. compared to China. Labor has been cheap for decades. Yeah, that's why the auto industry has been there for a very long period of time. So I'm wondering what has caused the change, what changed that caused investors to shift compared to 20 years ago when they decided to invest in China. Well, there's no significant shift yet because you need infrastructure. China has the infrastructure and the supply channels already built. So all of that capital has already been invested. So it is like, using up a factory without having to reinvest in it. It'll be used, and China will be used until you have to reinvest into something, and then the decision will be made, well, if we got to reinvest or spend any capex to expand, why not look somewhere else now? But being that all of this capacity has been built out, why not use it? Mexico would probably have to make significant investments in its infrastructure to begin to attract industries beyond the auto industry, which I'm very sure that the Mexican government is well aware of their position in the economics of the supply chain right now. What's your thoughts on agency? Agency is a mortgage REIT. All mortgage REITs are sensitive to interest rates, specifically the price of MBS. And as rates go up, MBS goes down. And if you look at the balance sheet of MREITs, what do you find? MBS. So being that they're holding this, when rates go up, the prices go down, what happens to the income statement, right? So you're going to have unrealized gains and losses depending on what their holding period is and how they hold these. It also depends on the amount of interest rate swaps that they use and whether or not they're getting gains on their interest rate swaps, or if their swaps are set up now such that they're generating losses on the interest rate swap. You have to dig into each MREIT to get that done, because most of them do use some form of leverage on top of just holding the MBS, because if that's all they were doing is holding the MBS, you could hold the MBS. There's no value generated beyond just the return on the MBS. So you have to judge it not on its price right now, but on its ability to sustain the dividend. Agency has a yield, I think, pushing up 15% at this point. I don't know if that yield is going to be sustainable, or if the dividend will change to right size that yield. The interest income component that they're getting is still the same. The double hit that Reits get is that payments on MBS prepayments slow down. So the speed, that's called the PSA, the speed of the MBA slows down. So that means they'll get principal plus interest, and usually they would get prepayments. Well, interest rates are very high. You would like these prepayments to come in faster, because then you can buy MBS that have higher yield. But that slows down, so you end up holding lower yielding securities for even longer than you would like. So the amount of principal you get for reinvestment slows down, but you're still getting your principal and your interest. There's no default on these agency MBS securities. There's no default. So you're still going to get everything that you're going to get. It's just that the market's paying more somewhere else. So the price of the MREIT has to adjust such that the yield that you're getting on the portfolio of assets that the MREIT holds is comparable to what you would get if you just walked somewhere else. Why would I buy shares of agency when I can buy the 10-year, right, and get a certain yield? So it's going to have to price itself based on everything else that generates an interest rate return. It's just not the time to be in MREITs right now. When the Fed is raising rates and it looks like this, you have to get to this point. Once you get to this point, then that is when I would say that they've probably hit a bottom, and now's a nice time to sit in them. Next one, pardon my ignorance, but at 1830, if rates increase, economy is getting better, wouldn't spreads decrease? Fixed income level 3, typically if we have a business cycle that looks like that, as the economy improves, rates increase, but because the economy is improving, credit spreads would decrease. That's not what we have right now. We're more likely over here. We have a lot of stress in the economy. We're in the slowdown phase. We know that because growth is slowing. All measures of growth are slowing. Leading indicators have been negative now for 7 months, have been turning down for 7 months, and we're facing a likely recession. The spreads are highly correlated with equities. A very high correlation between the spread and equities, so that when I say they're correlated, let's put that negative sign in there. As equities are increasing, credit spreads are decreasing. As equities are dropping, credit spreads tend to increase because of that negative correlation. We're not seeing that right now. So that's, this is typically a true relationship that, as equities increase, corporate bonds, especially high yield bonds, increase in price because the spread decreases. And as equities turn over, spreads widen and the price of high yield bonds roll over as well. So the prices of high yield bonds and equities are positively correlated because the spread is negatively correlated with equities. Does the mismatch of generationally high inflation in the U.S., and I said, well, that's globally, and raging strength of the U.S. dollar make sense to you? Well, there's some things that don't make sense to me, and when things don't make sense, you have to try to make sense of it. Okay, so we have the strength of the U.S. dollar. The question is, where else would you be? You need another currency that's big enough to absorb inflows. Well, a lot of the smaller currencies are not. The Kiwi, the New Zealand, the Aussie dollar, the loonie. These are not big enough to absorb the type of inflows that are necessary. You have money the yen used to be a big enough currency. The Swiss franc, the euro. Well, the euro and the yen really are not. So if you think about, well, if not the U.S. dollar, then where? And sometimes you can explain the strength of something by saying, well, okay, I don't know why this is so strong, but I can understand that if I had to choose another place to be, I don't know where I would go. This seems counterintuitive based on some CFA learning. My guess is this has something to do with inflation all over the world. Yep. And the safety of the U.S. dollar. Yep. To no better alternative. Yep. Asked and answered. You asked and answered your own question. Okay, first question at the top. What are your thoughts on paper trading for practice? That's a big yes on that one. Especially if you are a CFA candidate at level 1, level 2, level 3, and you have no real market experience, or you're detached from the market, which I find an odd thing. That I have spoken to some candidates in the past, and when I talk about the market, some answers I've gotten are in the lines of, I'm not aware of that, or I don't know anything about that, or I don't know. Oh, I didn't see that, I didn't hear that. And it's like, are you not aware of what's going on? If you ask a sports fan about the game, they'll talk for hours and hours and hours about the game, and they don't get paid to do that. It's not their career, it's just something they do on the side. That if this is going to be the career that you're going to choose, if this is the game you want to play, you need to be able to talk for hours and hours and hours about the game. So paper trading brings you closer to the real world. Not only that, it helps you make your mistakes in a very inexpensive way. I mean, you still want to try to outperform the market just because it's paper trading. I wouldn't start gambling in there and just seeing how much can I make. What you want to do is see how high your Sharpe ratio can be. And your Sharpe ratio is your return, whatever return you generate, minus an appropriate risk-free rate. So if you're only going to paper trade for a year, you could have bought a 1-year treasury. You could have bought that. So that's your benchmark. You got to beat the 1-year treasury. Take the return on your portfolio minus the 1-year treasury and divide it by the volatility, the standard deviation of the returns that you generated. Your goal is to try to get the highest Sharpe ratio you can. Not necessarily the highest return, but the highest Sharpe ratio that you can get. Hopefully a Sharpe ratio that is higher than the Sharpe ratio of the market itself. But I do recommend that because as you are holding securities, you become more aware of information related to that security. Here's a good example. Let's assume that you're in the market for a car. At some point, everybody here has been in the market for a car, and you decide on a particular model that you want. Do you not suddenly start to see that car everywhere on the road, or that vehicle everywhere? They've always been there. It's just you've never been attuned to it because you were out of touch with the car market. You weren't in the market, so you never really paid attention to what was going by. But once you zero in on one, you tend to see it everywhere. So if you start paper trading, you'll become more aware of what's going on in the market so that when you're sitting in a job interview and the conversation casually turns towards the market so that they can assess what you know and your ability to speak on the market on the fly, you can then start talking about it in a knowledgeable way as opposed to saying, oh, I don't know anything about that. If you were sitting in a job interview with me and I asked you about today the Bank of England started buying bonds to lower the yield on the 30-year, lowered it by 100 basis points. And I said, what do you think of that? Do you think that's going to cause the Fed to do the same thing? And you said, oh, I don't know anything about that. I would think, what are you doing? Like, well, what are you doing? You're not in this because you love this. You're in this for a paycheck. You don't want a career. You don't even want a job. You want a paycheck. I'm not hiring somebody who wants a paycheck. I'm hiring somebody who wants to grow and stand out as an individual. So yeah, I do recommend this wholeheartedly. I would caution optimism on yield spreads because the credit market numbers are delayed by a day. On Monday morning, we'll see the Friday's close OAS, which is true. Here are the latest OAS. For investment grade 154, not a lot of movement at all. High yield, we're over 500 now at 518. Big move down here, we're up to 1236. But let's just consider what's going on now, and let's look at a 10-year history on the OAS. Okay, we're going to look at this two ways. We'll look at this on Koifin and we'll look at it on Fred. On Koifin, if you click on market dashboards and find corporate credit, you'll get this screen up above the chart. There are 3 tabs. Click on the option adjusted spread, and for 10 years, I've got a high grade 1 to 3 years. That's the red line at the bottom. The pink line here is just a broad high yield OAS, and this is triple C. So let's start with triple C. And we look back to this period over here, 2015, 2016, those spreads reached as high as 2,000 basis points. And high yield at that time reached as high as 800 basis points. And contrast that period of time with now, we have a bear market in equities. We have global inflation, central banks rapidly hiking rates globally, a war in Europe that didn't exist before, and a looming recession in Europe. The winter's coming and there's an energy problem there. And rising geopolitical tensions, not just in Europe, but with some chest bumping between the U.S. and China over Taiwan. That you would think that there would be some extra fear reflected in the OAS, and even though they are elevated, it just seems that this period of time we perceived more risk at this period of time that was reflected in credit spreads, while there is more actual risk in existence today than there was back then. Let's look at Fred. This is a longer series going back to 1998, and on here the blue line is the high yield, and the red line, or the brownish red line, is the triple C. And if I move my mouse over here, everything just gets messed up with that little window that pops open. But over here you can see at the end of the chart where they happen to be, and if you draw a straight line back, you can see that there were periods of time on triple C. Here we got to 2000 here. Well, this was a credit crunch, but it almost got to 4,000 basis points. Over here there was a long period of time where it was above 2,500 basis points. It just seems to me rather benign, and same with high yield down here. It just seems to me rather benign. But rather than going back to the screen we were just on, let's pull up another comment that somebody had left, and maybe that will help us answer this, what I think is kind of odd. Okay, so this comment is near the top of the comments under the Market Outlook video, because it does have a link that you may want to link to. Actually, what I'll do is I'll put this link down in the description box below this video. I just thought of it now. I have some comments on the imbalance between credit markets and equity markets that you mentioned in this video that provides an alternative viewpoint. My personal thought is that given the current high inflation environment, existing bond issuers are less at risk for default. High inflation is good for bond issuers. For those that can raise their prices with inflation, yeah, that is true, because your revenues will go up with inflation, but the value of your bonds don't go up with inflation. And that is assuming that the increase in revenues that you get because of inflation outweigh any drop in revenues you'd experience because the quantity you're selling drops. Because that's typically what happens going into recessions, is quantities drop, and then you have pricing pressure on the downside. You have to lower your prices. But right now, with inflation going up, revenues can go up without the face value of the bonds increasing. Next, it is possible that many companies were able to refinance their debt at lower rates. Yeah, a lot of the debt sitting on corporate balance sheets was already there, meaning they were able to delay the effects of higher interest burdens. This is something suggested by Neuberger Berman, CIO of Fixed Income, this morning, and by BCA Research. Only 8% of high-yield debt is set to mature in the next 3 years. Additionally, BCA cited in the research interest coverage ratios are near all-time high in the U.S., approaching 9 times. So this brings up an interesting point. I think this has kept a cap on credit spreads for the time being. Yeah, if you have interest coverage ratios that are that strong, that means you have profitability that is that strong. And if you have profitability that is that strong, where are equity prices going? Equity prices are beginning to price in a recession, and there is the discussion looming that earnings have to come down. Earnings estimates have to come down. I've heard as low as 10, 15% for 2023. That they're going to come down. And if you're at 200 and that's justifying a 15 times earnings, you're at 3,000. If that's the case, if that is the case, then that interest coverage ratio is not going to hold going forward. You're not going to have 9 times interest coverage ratio going forward. Being that only 8% is maturing in the next 3 years, you would have a downward sloping term structure of credit spreads on high yield, meaning anything that's maturing in the next year or two would tend to have higher OAS, and something that's 5 or 6 years out would have a lower OAS because you'd be projecting a better environment at that time. So you can have a downward sloping term structure of credit spreads. And the link is at the bottom. So the argument here is that, this is not like any other time. Companies have a lot of cash on their balance sheet. They're still very highly profitable. And the interest, the coupon expense that they're experiencing, because that is their cash outflow, the coupon expense they're experiencing is relatively low because a lot of this debt was put in place before yields started increasing and spreads started increasing. It's not that they haven't increased, they have, just seems rather underwhelming. Now, if we accept that argument and say, okay, well, credit spreads seem to have it right, then I would seem to think that equities have it slightly wrong, that perhaps we're undervalued on equities at this point. But if equities have it right, then at some point credit spreads are going to have to play catch up when they say, oh, we forgot about profitability. It looks good now, but the next year is going to be pretty bad. Although with low coupons, yeah, you probably could have a significant drop in profitability of 20% across the board without it really affecting the coverage ratios. So I think that's a good counter argument. Anyways, there's the link. I will put this link in the description box below this video so you don't have to go back to the Outlook video to find it. Okay, we left off here. I have a question regarding the Fed's pivot. Let's get rid of the word pivot. I know that you put it in quotations. Very good. Being careful with that word. Let's replace it with pause, because I think you'll see a pause before a pivot. As per my understanding, the Fed will only pause in 2 scenarios. Inflation is fully managed, the job is done, and there's no need for further tightening policy. I don't know that they need to see that the job is done. I think what they need to see is this: for a period of time, like over a 6 to 8 month period of time, they see inflation coming down. I think that is enough for them to say, hey, you know what, we're on the right path. Let's just stay here. I don't think that, if it falls from 4 to 3.5 to 3, I don't think at 3 they'd still be saying, no, it's not 2, let's keep going. I think they, once they start seeing this trajectory going, I think they're going to be on pause, and then they're just going to see, does that momentum carry forward. Or economic growth, income growth, and the labor market all suffer at the same time, as they would all suffer at the same time, as inflation remains high or moderated. Too much pain is done. Yeah, either, they're starting to get some political pressure now. Politicians are starting to, not just murmur, but, sort of boo from the crowds at the Fed. So it's, the next time Powell is on Capitol Hill for the hearings, usually there are 2-day hearings, it's going to be a circus. I think he's going to get it from all sides. But, I think we can say the Fed has made some significant errors. And I don't know how this is going to end. I don't know that it'll end well. But I think that Powell probably will be remembered as one of the worst Fed chairs ever. Why they were continuing to buy mortgage-backed securities for the whole year they were buying it, up until they stopped when housing prices were clearly 20%, 30% year over year. Why you felt you needed to support a market that was doing that, I don't know what you were thinking. They could have stopped that some time ago. And didn't. They could have slowed down the pace of bond purchases a long time ago. I'm kind of on the fence on that one, because the fiscal side ran these big $1 trillion deficits during the pandemic. Well, you had to have somebody buy that stuff, and it had to be bought at a reasonable price. Well, the Fed probably was the only buyer at that time, but somebody had to buy that stuff. So maybe they couldn't, maybe they had to buy that stuff, but they could have stopped the purchases a while back as opposed to wait all the way until inflation was no longer transitory. And then the July press conference was just a train wreck. Powell said things he should not have said. Things that you really just couldn't defend, and that caused that market rally, which then caused him to say what he said in June, and now you have all of what's going on now. I think they're bumbling from mistake to mistake to mistake, and it appears to me that they're willing to make another mistake to correct a past mistake. Which is why I think it was early August where I said the probability of a recession now is 100%, and it will be Fed-led. And I do think that is the path that we're on now, unless somebody yanks him out of there and says, okay, we've got to try something different here. Where are we here? Scenario A seems quite naive and unrealistic in the future. For core, yes. I think getting core down to 2% in 8-9 months is, I don't know that that's realistic. Headline, no. Because you can cause deflation in other categories so that the headline inflation would look like you have deflation, because a lot of flexible components end up dropping quite a bit. But the sticky components come down slower, and I think that is where the focus is on the core. It does not look very positive. The economy is ruined, and inflation is still above 2% sustainable levels. As a result, I'm not sure why the market sees the Fed's possible pivot as a positive sign and rally on that information. I never thought that was realistic either. This 660-point rally you had over 60 days in the summer, once you got to 3,900, I thought, well, that's reasonable. 4,000, it's a stretch. 41, 42, 42.50, almost pushing 43. I thought, this is, what are people thinking? And they kept rallying, even though Fed officials kept saying, this is fantasy. This is not going to happen. This is not going to happen. And the market just kept saying, we don't believe you, we don't believe you. So I think part of the problem, part of the mess that we have today, and part of the Fed response that we have today, is the market's absolute unwillingness to believe anybody from the Fed during those 60 days. So the market has some blame to shoulder on this by taking it way too far and openly fighting the Fed. Well, what do you think is going to happen? So now we have this, right? Jay Powell made a possible rate hike pause. It would be interesting to see the thought process on this one. Well, that is my thought process, is that, the Fed made some mistakes. They should have stopped the bond buying sooner, and they should have canceled press conferences, because Powell is not good on his feet. He should just read from a teleprompter and leave the room. Discussions in the summer of whether he'll be more like Arthur Burns or more like Paul Volcker, and I made the argument he should be more like Alan Greenspan and shut the hell up. Don't give any guidance. He said forward guidance is dead, but what's he giving? Forward guidance. We're going to raise rates, and we're going to raise rates, and the dot plot, what is that? Forward guidance. So, I don't know that that's an effective group of people doing what they're doing right now. I think they need to be a little bit more quiet. But it is what it is right now. I think he's in a difficult position because here's the thing. He can't tell the truth now. He cannot tell the truth. So let's say that they all believe that, I think we've gone far enough. I think we have. But they know that if they say that to the market will undo what they've done, and they'll only have to go further. So I think that perhaps there's a growing consensus that they've gone far enough, but they can't say they've gone far enough because the market will then begin to price in the fact that they've gone enough, so they got to keep it a big secret. They cannot tell the truth at this point. But they did it to themselves. Instead of canceling forward guidance, they should have canceled the press conference altogether and just said, here's the statement, that's it, and let the market figure out, is it over? Are there more? Are there fewer? Are we near the end? Are we not near the end? And let the market place the odds on that instead of having to do what they have to do now. So yeah, I think they're in a bad place. Let me say something about liquidity, because that was a question that was asked on LinkedIn, especially in the Treasury market. that there is some belief that the Fed is going to have to stop its balance sheet runoff to fix a liquidity problem in the Treasury market. So what does this mean? Liquidity broadly is the difference between the bid and the ask on a security. A very liquid security has a very tight bid and ask spread so that transaction costs are very low. And when transaction costs are very low, the market can move in and out of these securities with ease at a price close to what its value is. In times of stress, this tends to widen. When this widens, liquidity drops because there are fewer people willing to transact when the bid-ask spread is that wide, because that is a transaction cost. So when you factor in the transaction cost, sometimes it's not worth doing anything. If there's enough risk in a particular market, which there are in treasuries right now, because those things move how many basis points every day. So if you're in the 10-year, the 20-year, the 30-year, there's so much price risk holding anything even for just one day that dealers don't even want to hold inventory. So what happens is you get even wider bid-ask spreads because a dealer has to be compensated for holding inventory. And then nobody wants to trade, and that's how liquidity dries up because the transaction costs are so big. And the less volume there is, the wider this thing has to go because of the dealers. Well, the dealers have to make a market. That's what they have to do. They have to make a market in a particular security. That's the role that they have to play. And if they don't do that, they lose that particular ability to make a market, which can be a lucrative position to have. So they do have to post a bid and an ask. However, it's going to reflect the risk of holding inventory, which is why you start getting these wider bid-ask spreads. And the wider it is, we say that liquidity is dropping in the market because fewer and fewer people want to transact at those wide bid and ask spreads, which then makes them wider and wider. So the Fed has to step in and be a buyer. And when the Fed is a buyer, then dealers say there's less risk in holding inventory. These spreads tighten up, and then everybody comes back into that market and starts trading again because transaction costs are low. The Fed doesn't necessarily have to buy to get the bid-ask spread down. The Fed just has to say, we are okay with a bid-ask spread of this percentage of the price. Anything wider than that, we're going to step in. We'll step in to either be a buyer or we'll step in to be a seller. They can be a market maker. They've got a big book. They can be a market maker themselves if they want to. So they can do it that way. They don't necessarily have to keep building up on their balance sheet. But if this gets too wide, like this, well, then there is a liquidity issue. And yields, I think yields use I think they use the bid on this one here, because if you're selling, you got to sell on the bid. I think they use the bid because it would have the higher yield. And if they're using the bid and you have this spread going on, you could get mispricing in treasuries because the bid is being used for the yield. I think the bid is being used. When you have a spread, you can calculate the yield based on the bid and based on the offer. And the wider it is, the wider those two are apart from each other. Anyways, there's the answer on liquidity. Okay, how do you display the volatility under the price chart in IBKR? Open up a chart. At the very top, you have your menu. Click on Edit. The first choice in the Edit menu is Chart Parameters. Click on that. A dialog box opens. Look down for the segment that says Additional Data and Features. There's a whole bunch of boxes in a number of columns. Looking at the first column, fourth box down, that is Implied Volatility. Let's see, although the name of the game is inflation right now, deflation may be the real issue with interest rate hikes being hiked aggressively. To my understanding, these rate increases come into effect with about a 12-month lag and are already seeing some big negatives in the CPI print. Thoughts on how to position apart from being in cash to increase purchasing power. Well, let's tear this apart here and let's make sure that when we use a word that is actually the word that we wanted to use. You're using the word deflation. We have to distinguish between price decreases versus deflation. So let's say that I have a class of students there's going to be a class average, but some people may fail. The class average may be 72. Some people will fail. Well, some people failing are equivalent to price decreases. The class average is equivalent to the price level. So if the class average was going from 72 to 70 to 65 to 62, that is equivalent to deflation. Something is going on in the class as a whole. But if 3 people are failing and the next semester 4 people fail, but the class average stays at 72, well, yeah, you have more failures, more price decreases, but not necessarily deflation. So even though we're seeing some price decreases, deflation is a weighted average of everything. And we have to make a distinction between the type of price changes we have. Are they cyclical, structural, or event-driven? Cyclical means, if you have a business cycle and at the top of the business cycle when inflation is high, if you're raising interest rates, you'll slow down the economy, maybe tip it into a recession, prices come down. But that is not a structural drop in price. It is just reflecting the fact that while times are tough, prices will adjust downwards until they readjust upwards again. That is cyclical. Structural is where prices decrease over a very, very long period of time and they just go straight down. So technology is an example of something that creates deflationary pressure. If we look at any technology, prices have only come down over time. And you go back to the 1990s and you buy even a 20-inch plasma TV, you would have paid $14,000. Well, those things are gone now, and now you can get 100-inch LCD TVs for $4,500. And so those prices just keep going down, down, down. Automation decreases costs, continues to decrease costs. So that is structural. When you have way too much of that going on, that can become a problem. And then you have event-driven. So the pandemic was one of those event-driven things that actually boosted prices because of supply chain constraints. So the word transitory was appropriate to use in the beginning. However, if transitory stays around for too long, it can become structural in the sense that it becomes embedded in wages. Embedded meaning that I'm going to get 6 or 7% wage increase every year because that's what inflation is. And employers will give it and they'll raise their prices 6 to 7% for the year so that next year they have to give a raise of 6 to 7% because, of course, prices were higher 6 to 7%. So they raise their prices another 6 to 7% and on. And that's wage price spiral. So you got to make sure that anything that's event-driven gets cured very quickly so that it does not become structural. It's okay if it becomes cyclical as long as it does not become structural. And the fear that the Fed has right now is that it's going to become structural, and that's the last thing that they want. Although my counter-argument to that would be, so what if it's structural? So what if it is structural? Let it become embedded. When we live in a world of technology, the free market will cure high wages very quickly with automation and productivity gains. Robotics, AI, all of these things will happen at an even faster rate. It is something that John Hicks, if you want to look up this guy, 1932, called induced innovation. That if you want innovation in a particular sector, raise costs in that particular sector and let the free market work. When you raise costs in a particular sector, companies will be motivated to find a way around that cost. They'll either find a different process, they'll either use different materials, or they will introduce some sort of automation or technology that then replaces the human that was there. So even if it is structural, you don't necessarily need high interest rates to get rid of it. You just need an environment in which venture capital and innovation can flourish, where companies are willing to invest in technology, invest in automation. But the higher you push interest rates, the less likely you're going to get investment. The more that seed money pulls back, the more that venture capital money pulls back, and you don't get the free market answer to higher prices that you would like to get. So there is some argument. It's a very Austrian economics argument saying, let the free market do what the free market does best. The best cure for high prices are high prices, because companies will innovate around higher prices, and sometimes you can get incredible innovations when you have pricing pressure and motivation to change that pricing pressure. So perhaps the central bank, by raising rates right now, is working against the very free market economy that we think that we're trying to protect by raising rates to get rid of inflation. Inflation may just be a signal that the market needs a solution, right? A free market solution. You want the market to be as free market as it possibly can. But over the years, there's been more and more and more intervention in markets, more and more government intervention, more and more monetary intervention. And it can fix itself. Yes, it'll take time to fix itself. I was having this conversation the other day with somebody else who has a YouTube channel with AJ. And I was saying that this is a very precarious time for the Fed, because we just came out of a pandemic where we shut down the economy, and we came to realize that the cure, shutting down the economy, was worse than the disease. And here we are raising interest rates, and there's a growing consensus that the cure, a recession and unemployment, that the cure is worse than the disease. And being that we have the pandemic fresh in our minds to tell us that that is the issue, and this is going on, I think the Fed is probably going to hit a lot of political resistance, and I mean a lot of political resistance, before they can actually get to the end of what they want to do. Next question. On lower labor costs in Mexico versus China, I was wondering what a good resource was to find this kind of data. Google. Always look for secondary research first. Don't worry about primary research. Look for secondary research. Just type in average wage rate Mexico versus China, and you'll find a lot of good research that's already been done on that. Could you comment on number of security names you hold, or a number that an individual might lean towards holding? There is no one answer to that, and there is no simple answer to that, because everybody is different. Everybody is at a different stage of their experience and of their knowledge. Everybody has a different level of capital that they're playing with. Everybody has a different level of risk aversion or risk acceptance. So there is no one single answer to that. I will say this: you should not copy anybody, because you don't know if your circumstances are the same as their circumstances. When I say things and I do things, I'm doing it more to show the process that I go through and how I come to my conclusions. I don't want you outsourcing your thinking to me, saying, well, I'm just going to buy what he buys and sell what he sells. I don't want you doing that, because you don't know what other things I hold in my portfolio. So when I say I'm selling calls on the SPY at 380 on any rally up, you don't know what other positions I have that I'm selling calls to hedge against a drop in price in. So I wouldn't be copying what I'm doing. I would copy the process and the thinking I go through, but I wouldn't try to say, you hold 50 securities, I should hold 50 securities. I hear you say many names of positions you are adding to. However, struggle with how many securities I, as a retail investor, should be managing a portfolio around. If it is your first time in the market, there is only one security you should hold, and that is SPY. As far as equities go, I'm not going to talk about bonds or anything like that, but equities, hold the market. Just hold SPY. Hold an ETF that tracks the market. There are 11 sectors in the market. If you have a reason to believe that a sector is going to outperform SPY, you step into the sector. So if you think, well, a safe place to be right now is probably utilities, you would then buy XLU. You'd buy maybe 60% of your money in SPY, the other 40%. I'm just throwing out numbers just to show you how you would overweight, because SPY already has utility exposure. You'd lean in to a particular sector. Well, within utilities, there are industry groups. If you believe a particular industry group will outperform, then you could start looking at companies in those particular industry groups. So you start from the market, you work your way out. Your portfolio breadth. The breadth meaning you're holding equities, you're holding currencies, you're holding some commodity exposure, you have some fixed income exposure, is a function of your experience and your knowledge. If you have very limited knowledge and no experience in the market, your portfolio breadth should be very, very small, which means you're holding just the market. The idea of buying names that you are very unfamiliar with, but that you hear floated around all the time. Oh, DocuSign, that's in the news today, and Biogen's in the news, and Tesla's always in the news. I'm going to buy those. You don't know what risk exposures you have. And so you're not going to know when those stories are done. Whereas if you start with the market, well, then you already have a very diversified portfolio right away. And as you gain knowledge, you can step out of the market. And the more knowledge you have in a particular sector, the further and further you can step away from holding ETFs to then holding individual names. If you say to me, I'm going to buy ABC. Okay, buy ABC. But you could also just buy the market. You have to believe that ABC is going to do better than SPY. You have to believe that it's going to do better than SPY, which means you need some view on where you think this is going. Where's the market going? And once you determine where the market is going, you can then ask, well, will this go in the same direction, and will this do better than this? And if it won't, let's say ABC goes up 6% over the next 2 months, but SPY goes up 10%. Well, then you failed. You failed because you bought something that gave you a 6% return when you could have done no thinking and got a 10% return. So it's not about the number of securities that you hold. There is no magic number to the number of securities. You hold SPY, what does it have now? 508? You now have 508 securities. You have exposure to 11 sectors of the economy. There you go. You're diversified. You will get the market return. If you think that the market is going to be weak for a period of time, well, you can then sell calls on SPY. So you can buy SPY at, where are we now, 370, and you can sell the 380 calls for October. So if the market drops, well, you're going to drop as well, but not by as much as the market because you already had some premiums. If the market moves up and it gets called away from you, well, you get a quick $10 return, plus you get all the premium from this. And this is how you gain experience on where you set your calls, where you set your strikes, how to read the market, how you feel about where the market can move. Experience, knowledge. Those two aren't the same things, by the way. Knowledge is more like formal education. You learn about this, you learn about that, you learn about this. Applying that knowledge gets you experience. Now, you can get knowledge through just experience, but it's going to be super expensive, because how much money are you going to lose to earn that knowledge? Because that's how we learn. We don't learn when things work out for us. If we buy stock ABC and it goes up 10% and we sell it, we think, my God, I'm smart. We didn't learn anything because we rode a wave. You only learn when you make mistakes. And that tuition fee that you pay, the money that you lose, is only worth it if you actually learn from that mistake as opposed to repeating it again and again. So if you're new to this game, get some knowledge, do some paper trading to get some experience. The greater your experience, the greater your knowledge, the more you find that you're comfortable saying, you know what, I have a familiarity with this and I have a familiarity with that. And you start spreading out from the center, which is the market. Your first move should be, I'm going to be in equities, I'm buying the market. That's it. You're buying the market unless you have a reason to believe that another sector will do better than the market, then you move into that sector. From that sector, you then say, which industry group will outperform the sector? And if you have no opinion on that, then you stop at the sector. And you buy a sector ETF and you be done with it. Long answer, but there we go. Okay, what do we have here? Well, your thoughts on this week's action in US CAD. Monster moves to 136, and this morning we breached 138. I think we're around 130, 137, high 136, 137 now. And with the recessionary backdrop, at least in Canada, that almost seems to be a certain thing now. Busting out of a long sideways range, 125, 130, and higher for longer narrative. Do you now think this will support U.S. further? I don't know if it'll support U.S., but it certainly isn't going to support the Canadian. The Canadian seems to be down for the count. It seems to be, looking more at the next, 3 to 4 quarters as opposed to the next 3 to 4 years. And I think you got to get through the next 3 to 4 quarters. Currencies are brutally hard to forecast, notoriously difficult to forecast, especially in uncertain times where visibility is limited. And right now, to say where are we going to be in 6 months, not a clue, because I don't have that much visibility right now. When volatility is low and you have economic momentum behind you and that you have a growing economy, it's much, much easier to do. But right now, brutally difficult to do. So I'm a long-term bull on the Canadian dollar because we are a resource-based currency. And just the amount of materials we're going to need going forward for a transition to a carbonless future, and the amount of energy, traditional energy, you still need to make the transition, that is everything Canada has. So why this complete overreaction? I don't know. Now, the weakness in the CAD is specifically the US. If you look at the CAD against other currencies, it actually is outperforming most other currencies except the peso. And the ruble. The ruble has outperformed the Canadian dollar this year. The ruble and the peso have outperformed the US dollar this year, believe it or not. So it's primarily the US that's giving the Canadian a hard time. If you look at it in any other currency, the Canadian's actually doing quite well. But it doesn't help when you have futures that are US based on the Canadian. Let's see, I had a question on credit default swaps. What are your views on the CDS, looking at CDS to gauge stress or potential upcoming black swan event? Well, you're never gonna get an upcoming black swan event just by looking at things, because that's the whole idea. They're black swan. It'll be the last thing on your mind. These things, black swan events, are usually exogenous, which means they usually come out of nowhere. Something happens. There's some event that happens that just triggers something, and it's something you can't forecast. Some Lehman moment that you can't forecast. As far as CDS are usually based on what the current OAS is on a particular issue anyway. So you already have the OAS in place anyways. Any derivative doesn't have its own price. The derivative is a function of the price of the underlying. So because a derivative passes through the performance of the underlying, it is based purely on the price of the underlying. Now, there can be a spread between CDS pricing and OAS. There can be those spreads, but those can always be closed with arbitrage. So I don't know that you're going to get much by looking at the derivative over the actual spread itself. And I'm not even sure where you would, as a retail trader, get good information on this, because this is an OTC market. Can you please elaborate on how Koifin compares to Bloomberg, especially in terms of security scope? Do I get details on bonds and financial reporting data from company? If you're looking, I had a Bloomberg subscription for a year thinking it was going to be fantastic, and it was, almost anything I could get on it, I could get somewhere else for free. So, when you look at it, you say, okay, well, I'm paying 30 grand a year for an aggregator. You're just aggregating it all in one place so I can see it. If you're not into fixed income, and I mean right into the fixed income side of things, you can get anything on Bloomberg anywhere else for free. I shouldn't say everything. Almost everything, at least that I've seen, I can get in other places for free. Much of the stuff I can get for free already. Some of the interpretations that they have, some of the transformations they have are unique to them. But if you're just, as far as a retail investor goes, it is massive overkill in terms of what is there. Most of the time, you might only need 5% of what they have, especially if you're not in the fixed income market. And I don't mean just buying a bond here or there. I mean, this is what you do. You're a fixed income portfolio manager, or you're on a fixed income trading desk and you need that data. Beyond that, I didn't find it useful at all. I found it far more useful for me just to go to the source of where I wanted to go, as opposed to spend all that time learning a new interface and how to find everything, when I already knew how to find everything I needed anyways. As far as Koyfin on financials, let's just have a look at what they have. Okay, so they have a bunch of plans across the top here. They do have a free option for you as well, and you could see the core data and functionality. What they have down here is available for all of them, except the mutual fund data is only in the Pro plan. So if you don't need mutual fund data, who cares, right? But everything else is here. You have snapshots and analytics, a bunch of information here. Analyst price targets, consensus Wall Street estimates, earning history and surprises, dividend summary, and this is for free. It's only those components of the S&P 500. This is all global. If you want to step outside of the S&P 500, there you go. News from the web, global market news, company filings. I find this useful. Transcripts I find really useful. If you have the Pro plan, you get the full history of transcripts. Document search, you get all of that. You get all of that in the Plus as well. Financial statements, 10 years. So you can get 10 years of financial statements. And the data they use, I think, is IQ Capital. So it's cleaned up data already. This is the problem with a lot of sites that have financial information, is you can never really be sure if it's correct financial information, because it's just an algorithm that reads something. So it doesn't take any time to say, well, this line should collapse with this line, or this line needs to be broken out, or this data is missing because it's over here in the cash flow statement. So this data is cleaned up. And then you have watch list, custom dashboard. This is, depending on how functional you want this to be, right? But if you're looking for financial statements, company's balance sheet, income statement, enterprise value, cash flow statements, you have 10 years, which is what Bloomberg would give you in a spreadsheet as well. You could access 10 years of the data. So depends on what it is you want. For most of what you're doing, the Plus plan will be sufficient, and this is on an annual basis, $35 a month. When you compare that with, what did I pay in equivalent? I think it was like 25,000 US for a year of Bloomberg. This would be what, $420 versus $25,000. So the extra $24,500 to me was, if I was in the fixed income market and that's what I did with significant dollars behind me, then yeah, I would find that probably useful. But as a retail investor, massive overkill and not necessary. That this is probably sufficient for you. Okay, you previously talked about leading and coincident indicators for the overall economy. Could you please discuss leading and coincident indicators for corporate profits? Well, corporate profits are a lagging indicator. So what you're asking for are leading or coincident indicators for a lagging indicator. That's you're not going to find that at an aggregate level. You're going to have to find that at a micro level. It's going to be industry specific. For example, if we're looking at mining companies, you have to look at the commodity price over the quarter. What was the average commodity price over the quarter in order to forecast revenues? What was their forecast for how many tons or how many ounces of that particular commodity they were planning on mining over that particular quarter? Then you have to look at energy costs, because it is a significant expense for mining companies. Sometimes 35 to 40% of their cost structure is just energy costs. Well, what were energy costs over the quarter? What you'd like to see, which you rarely get, is rising commodity prices but dropping energy prices. Mining companies do really well. That is a leading indicator of corporate profitability at this specific level, but it may mean nothing for a software company. Software company may say, we don't care what energy costs are or what the price of copper is. It means nothing for us. It may mean something else. So something like GDP growth. Real GDP growth is more important for those types of companies. So you can't, I don't know that there is a leading or coincident indicator for a lagging indicator in that sense. I would assume it's some combination of PPI growth, employee earnings growth, yields on new refinanced corporate debt, maybe nominal GDP. This is what CFA level 2 will do, especially when you get to equity analysis. It will sharpen your thinking in terms of actually we can the equity section is more about valuation. Look in FRA for 2023, the last two readings in FRA. One of them is just a big long case study on how I think it's a Nestle that we look at line by line what drives, what are the drivers there. And then the next one is industry and company analysis, where you're looking at how would you assess an industry as far as the drivers of profitability are concerned. So it really is more of a sort of a bottom-up approach for a particular company, or at least a top-down approach at an industry level to determine, well, what are the drivers that drive profitability within the particular industry, as opposed to something like, well, I'm just going to watch PPI and wage growth. That may not be specific enough to the company or the industry that you're looking at. On the day of the FOMC meeting, market initially went up for about an hour as Powell speaks, and I think that's why he left. 3:15, because typically he goes to 3:30. 3:15, he answered a question. He said, "See you later," and he took off. Like, he basically took off. He ran. I think somebody on the side was motioning to him, shut it down, market's rallying. He got the hell out of there. Let's see, it suddenly dropped in the final hour of trading. Would you be able to cover the reason for the quick reversal? Always, whenever something like that. Not really. There are all sorts of non-linearities that happen in the market that if you repeated that day 10 times, you might get 10 different outcomes from that day. But that having had the day, that was the outcome that you had. It's kind of like a quantum riddle, right? The cat in the box it's both dead and alive until you observe it. There are so many non-linearities in the market that sometimes all it takes is one event, which on its own might not have done anything, but one event then forces somebody else to do something that might be correlated with the first event, which then causes a cascade of correlated strategies, and suddenly it gets a momentum and a life of its own. So it's, sometimes things are very specific. There's an event that happens, the market changes direction, and it stays in that direction all day long, and you can point to the fact that, hey, listen, it was what Powell said at this time, the market turned and did that. But when it does these, I'm up and I'm down, I'm up and I'm down, now I'm down, this kind of thing, it's hard to break this down to, well, because he said this at this time, which caused this, and then he said this, but then he said that, and then he said, anybody who's doing that kind of thing is trying to add causation to something they observe after the fact, which I don't know really. We like to make sense of things by telling a story. This happened, and that happened, and this happened, and sometimes things happen because of non-linearities, and that's just what happens. So not really, just this is called volatility. That's all that is. If I understand correctly, if discussed discrepancy is correct and we expect this anomaly to disappear, we should be long equities and short bonds, or long credit spreads. What we're saying is, one of the two is wrong, or at least I said either credit spreads are wrong, or market pricing, I'll just put P naught, is wrong. One of these two things are wrong, and I think what you're trying to say is, well, how do we trade these two things off together? Well, the first thing you would have to do is do some kind of analysis between these two things to determine what the long-term relationship between these two things are. And whenever these relationships, if there is a relationship, if they deviate, how far of a deviation do they go before they tend to correct? 1 standard deviation, 2 standard deviations, and how long does the deviation persist before it does correct? It's not as simple as saying, aha, I see arbitrage. This is not arbitrage because it's not the same underlying asset. You have two different asset classes that are somewhat correlated that typically have moved together, but nothing ever moves together in lockstep. There's a correlation, and correlations can deviate from each other for a period of time. So when you do an intermarket analysis for something, you will look at the performance of something. Let's say this is 0. You'll look at the performance of something over time versus something else, and you may find that, well, this one does, it holds very close. You can do a correlation analysis. You might find the correlation is 0.96. But then you see this going on at some point in time, and you'd say, uh-oh, hang on a second, this relationship is broken down. Why? Why is it broken down? So we have what appears to be a Y over here. Why is it broken down? And how persistent is this relationship? Has this happened before? When it does happen, you'll have the relationship plotted that looks like this, deviations from each other. Then you'll have little bands around it, 1 standard deviation, 2 standard deviations. And you'd have to find out, well, it appears that when you get to about 2 standard deviations out, it tends to correct very sharply. And you may find that this relationship diverges. We're 1 standard deviation away on the divergence. Well, maybe that's not enough. You know, it's just not time yet. It's a form of technical analysis when you do intermarket analysis, but when you're doing cross asset stuff like this, it's not that simple. You have to have some home relationship of which you expect these things to return to. So you have to first figure out, well, what does home look like? How strong is home? And how far away from home do these things get before they return back to home? For the applied series, when we're doing the top-down analysis, we do a lot of this stuff. Intermarket analysis, that is top-down, not just economics. There's an economics part of, well, what are the big economic drivers of different asset classes? Because we want to make sure that we're in the right asset class at the right time. That's the biggest part of returns. But there are relationships between asset classes that can tell us turning points in different markets, or there are deviations in markets where we can say, is this permanent or is this temporary? If this is temporary, the trade is right here. If it's permanent, the trade is somewhere else. And you got to figure out, well, if it's somewhere else, where is it? Is it on this trajectory or this trajectory? Okay, in level 2, you taught candidates about rolling down the yield curve. Yeah, and for that you need a stable yield curve. You'll see more of that in level 3, strategies for a stable yield curve, which seem to be for managers buying the actual bonds. Can you discuss this strategy in light of bond ETFs for retail? For example, let's assume by February 2023 the rate hikes are over and a retail investor buys the IEF, hoping to roll down the yield curve. Then you wouldn't be buying the ITF if you're hoping to roll down the yield curve. You wouldn't be doing that. The IEF is a 7 to 10. So when it drops below the 7, it'll just be sold out. He sees that the 1-year CDs are paying 4.25. The IEF 7 to 10 Treasury bond ETF is paying only 2%. He decides to go with the bond fund, anticipating rate cuts in the next 2 years and to outperform the CDs through price appreciation on the bond ETF. Well, that is not a roll down the curve strategy. That is a strategy for a dynamic yield curve, and it is lean into duration. If you anticipate rate cuts, you lean into duration, plain and simple. It's not a question of riding down the yield curve. It's a question of yields dropping and prices rising no matter where you are. And if you think that's going to happen, you want to add as much duration as possible. Riding the yield curve is slightly different, so I'll explain it. Let's say that you expect a stable yield curve, and let's say that we have a 3-year, 7-year, and 10-year at 2, 3, and 4%, and this is your par curve. Par curves are easy to explain rolling down the yield curve because par curves all have $100 bonds. Well, when I say $100, 100% of their face value. So the 100-point system means 100%, but let's say they're $100 bonds. I have a 3-year horizon, so I can buy a 3-year bond and I can realize a 2% yield over that period of time. But if I have a 3-year horizon and I expect a stable yield curve, I can buy a 10-year and sell it at 7 when it's a 7-year bond. So I will buy it when it has a 4% coupon. Because it's a par bond, I'll pay $100 and it has a 4% coupon. In 3 years when I sell it, it will yield 3% with a 4% coupon. This will be a premium bond, right? So I'll get a higher yield, 4% versus 2%, plus I'll get capital appreciation when, as a 7-year bond, it's priced to yield 3% to maturity with a 4% coupon. I'll get a capital gain on the premium. That's riding down the curve. So it's if you have a dynamic curve and rates are changing all the time, and you think that rates are going to drop, you want the highest duration you have because duration is a sensitivity. The duration is the percentage change in the present value of the bond for a change in interest rates. The benchmark rates fall as the investor hoped for. However, this strategy will not work for the retail investor who is stuck with the IEF holding a bunch of 10-year bonds issued in 2020 that have a 5% yield. Careful, that's a 5% coupon, not yield, a 5% coupon. The yield is a combination of coupon and the pull to par. So the yield is a combination of what coupon are you getting and what gain or loss are you realizing as the bond is pulled to par. So a premium bond will lose money as it's pulled to par. So that means its yield will be less than the coupon. And that happens when a bond is paying a 6% coupon, but the market wants a 4% yield. Well, then you're going to pay more for this so that in the end you yield 4%. You get 6% here, but you lose here. Discount bonds are the other way around. So the coupon may be 5%, but all the bonds will still be priced at the yield that exists in the market today, which is why the ETF has underperformed because the price of those bonds have gone down. If interest rates drop, that ETF goes right back up. You don't just get the 0.5, you get the yield. The coupon is just the cash flow component that you're getting. The other part of your return is the price appreciation in the bond itself. So this, I think you might be confusing rolling down the yield curve with pull to par. Rolling down the yield curve is something you would do in a stable yield curve environment. If you expect stability for 3 years and I have a 3-year investment horizon, why should I get 2% when I can get 4% and sell it at a premium in 3 years? If I expect rates to change, then I expect a dynamic yield curve, not a stable yield curve, in which case I want to lean into duration if I think rates are dropping. Just a question on technical analysis. You've said before you're not a big believer in it, but you do use it, however sparingly within the context of your macro trades. I guess my question are what exactly is your view on it, and what are the sort of patterns you find yourself trading? I don't trade the patterns. I'm aware of what the charts say. I'm aware of what's there so that I can be aware of what the larger crowd is thinking, but I'm not a technical trader. I don't trade the technicals. In the SPY, I point out that we have a double bottom, but I'm not trading anything about the double bottom, just that we do have a double bottom. And if it holds for a period of time, and I don't mean, we had this bottom in June and then we had this recovery. And if we did this and it immediately recovered off it, well, I don't find that a test of the lows. I don't find that a test of the willingness of market participants to step in at that price. What I want to see is there's the June low, we had the rally, here we are again. I want to see us bounce off it for a period of time and then slowly start to go up. That is a believable rally. That is absolutely believable and something that I can get on board because it is orderly. It is not these sharp V-shaped recoveries that you go, okay, well, this, you can't just go and touch the wall and run away from it. You got to hang out there for a while to show that it really is support, that it really is an absolute willingness of market participants to stop selling and start buying at that level. That when you dip below this level, there's less and less willingness to sell. That's what I want to see over an extended period of time. Then we have something. And as far as what I pay attention to the big things, just the big things, because those are the things that are most widely believed. Years ago, I think before like 2004, 2005, I had a subscription to a trade journal, a technical analysis trade journal out of Florida, not because I paid for it, because I got it free because of something else, and I can't remember why I got it free. And as you flip through the pages, there's this one article about this new technical indicator on the rice market in Singapore during the summer. There's another technical indicator for this and for that and for this. And well, those are shared or when I say shared, from a knowledge basis that I know it and you know it, by very few people, which means it affects the behavior of so few people, it's not worth paying attention to. But a double bottom, almost anybody that has any kind of technical analysis training would recognize that almost right away, which means the largest part of the market would recognize that that's a double bottom. So let me give you an analogy using religion. I'm not a religious person, but I'm aware of what certain religions believe in, so that I can then understand the behavior of some people. But to understand the behavior of a group of people, you don't really need to know all of their religion. You just need to know some big themes. That's all. Just some of the big themes, and you could pretty much tell what they're going to do, because most people who are religious really only know the big themes anyways. That once you start drilling them on the details of their religion, many of them come up blank and go, I don't know. Well, I'm sorry, but I thought you were religious. I thought you had this belief in this system, but apparently you only believe, the 2 or 3 big themes, and you ignore all of the rest. So if I were going to be in a culture that was dominated by a particular religion, I'd want to be aware of certain things, but certainly I wouldn't be taking a PhD seminar on that religion to learn all of the little technical details down to the core of it, because the vast majority of the population wouldn't do it either. Do you get what I'm saying on that? So if you are in technical analysis and you want to use it to some benefit, there's probably a few really big things that everybody knows. Well, that's it. But once you start getting into these really esoteric things that if you ask 100 people, 100 might say, never heard of that before, never heard of that. That, the 855th person you ask, oh yeah, I heard of that. Well, that's not going to affect anybody's behavior. That's not going to affect anybody's behavior. That's not going to move markets at all. So there's my short answer. I had a longer answer, by the way. I have a couple of questions about the REIT space. First of all, what do you think of the sell-off in REITs this year? Well, REITs used to be in the financial sector. Equity REITs used to be in the financial sector. And financials used to have anything that was interest rate sensitive. That's why equity REITs were there, because they're interest rate sensitive. And then they were spun out into their own category of real estate. So they are interest rate sensitive. They will act like bonds. Interest rates up, prices down. Most REITs are down 30 to 45% year to date, which seems a bit overdone to me. And to me, believe me, based on strong underlying fundamentals of most of them. For example, Cap REIT down 30%, Simon Property Group, Minto 42. How much more pain could we possibly see here? Do you think the current dividend levels are... how sustainable are they? I think they are quite sustainable. Look at their payout ratio versus FFO or AFFO. That is the measure of the sustainability of the dividend. Anything under 70% is more than sustainable. So if we look at Cap REIT, this is from Global Market Intelligence, the long-term dividend payout ratio 63.64%, current yield 3.57, 63.64. If you look at Minto, funds from operations per unit was 21 cents. This is for the quarter ended June 30th. 21 cents. Adjusted funds from operations 18.4. The dividend over the quarter was 11.87. That's a 65.2% payout ratio based on AFFO. For the full year, the first 6 months of the year, it's 68.4. That dividend is in no danger of getting hurt. Rentals.ca had a story about rents in Toronto up like 28% year over year. And so something like Interrent, which has a big Toronto exposure, the rents are up. And if you look at Minto's last quarterly report, same door NOI was up strong. So cash flows are up. What is bringing the price down is that those cash flows are perceived to be very bond-like. And because they're very bond-like, the REIT itself will be repriced like a bond. The present value of all those future cash flows will drop. But to me, that is just a buying opportunity. Let them drop, let them drop, let them drop. I hope they drop another 50% from here, because I've got a bunch of cash I'm sitting on that I would love nothing more than to spend. I will pick them up without a problem. I know that a REIT's risk and return profile depends a lot on the types of property that it owns. Yeah. Well, it doesn't really depend too much on the type of property that it owns. This is, there's this rule in real estate about, well, what do you have and where is it located? It's not really too much about the type of property. It's about the cash flow that property generates. Because any commercial property, any commercial building or apartment building or mall, anything is worth the present value of its future cash flows. So you can build a $100 million apartment building, and if you can't get rents for it, it's not worth $100 million anymore, even if you fully agreed that it would cost you $100 million to rebuild it from scratch. If it doesn't generate the cash to support that price, it's not worth it. So the risk and return profile depends a lot on the strength of the cash flow it can generate and the sustainability of that cash flow. I'm curious to know which sectors you're currently leaning into and which sectors you're staying away from. Well, residential, healthcare, I'm in. Self-storage, I've never really been too much of a big fan on self-storage. Only because I've never really seen good valuations on it. Just never really a fan of self-storage. Industrials are always good. I'm not here at all. I'm here only if they are anchored. I don't really like the covered malls unless they're A malls. So Taubman in the US is a bunch of A malls. Simon Property Group, I think, is a bunch of A malls. A malls tend to have very long leases in them. The only issue with a lot of the bigger A malls with these really long leases is, the Gap will go to one of these mall providers and say, you have 15 malls, we want to be in all 15 malls, and we're going to negotiate one big master lease. And it's usually significant. And since they drive people into the place, you may not have the rent escalators that you want. So when you have inflation the way we have, with very long-term leases in place, the escalators may not account for the increase in inflation. And that could be a problem with the malls right now. I prefer strip malls, and I prefer strip malls that are grocery anchored. Because they'll have a big grocery store at one end, they rarely ever go, and then they have a whole bunch of little stores. Maybe it's an L-shaped mall that looks like this. And I prefer them that are grocery anchored, and even better if they have government offices in here. Some dental offices and some doctor's offices in here because they rarely ever go anywhere. What I don't want is it to be restaurant anchored here with maybe a pizzeria on the end, and maybe a framing shop here and a gift shop there, and a nutrition shop over, like that kind of stuff. No, you want to stay away from. So you want to look at who they're renting to. Office, I don't mind office. I don't mind office properties at all, and I think the better value in office properties right now are in secondary locations, not gateway locations. So something like Boston properties, I don't know that I would be too excited about something in Boston properties, but in Canada, something like Dream Office Properties or Slate, I think I'd be very interested in each of those. So again, for Reits, you really have to pay attention to the types of cash flows that it generates, the stability of those cash flows, the vacancy rate over time, the growth in NOI year over year, the payout ratio as a percentage of AFFO. Adjusted funds from operations means after you have all the cash that needs to be reinvested back into the property for maintenance CapEx, whatever's left over, then that's free to return to shareholders. The lower that payout ratio is, the more the REIT can buy properties without consistently and constantly issuing new shares again and again and again and again, because that just dilutes ownership, right? Short answer. The Applied series, when I do the sector analysis for real estate, I will be diving deep into each of these and what drives each of these, and what to look for in each of these sectors, because each of them is an industry unto itself within the GICS codes. Okay, we can go quickly through these three. I agree with your thesis on Mexico and its favorable demographics. Why now? What are the recent catalysts that could make a thesis a reality? Is it both the friendshoring remarks from Yellen? I agree with that, yes. Over the summer in China's deteriorating demographics over the next decade. I wouldn't say it's so much about the demographics as it is the growing tension between the East and the West, between China and the U.S. over Taiwan. We know that China is unmovable on that topic. Taiwan is theirs, and there is no discussion to be had about that. So it is it's a bunch of chest bumping going on right now in the parking lot, but the expression, when push comes to shove, push typically comes to shove. And China seems to be aligning itself closer with Russia, or willing to be seen with Putin, and being Putin's friend than the West would like. So that's a looming problem, right? Are there more? Not well. For a long time, supply chains were about efficiency, right? Is trying to squeeze as many costs out of the system as you can to try to keep your prices as low as possible or your margins as high as possible. I think supply chains over the next while will be dominated by the word, resiliency. And for resiliency, it's not, you don't want to leave yourself open to an event where if something happens in one place, you're really messed up. If something happens in one place, you have another place that can get it done, that you can shift, the supply, your supply chain from location to location. So rather than having a single source, a single dominant source, mind you, but a single source for supply, you might have 3 or 4 different sources for supply. Previous videos, you mentioned some banks with attractive valuations and dividend yields. Do you think that these banks could sustain their current dividend yields? Do you foresee potential cuts? No, I don't. Never cut. Never cut, ever. Never cut. And during the Great Depression financial crisis, they never cut their dividend or lowered their dividend, and they have a history of raising their dividends. No, I see no problem there at all. Yield is so attractive right now, especially when you play the options on the way you do. I don't see how these strong banks can get beat up even more. Yeah, I thought the same thing with GM when it fell from 67 to 40. I thought, okay, the damage is done. I'm holding it. Why sell now? And it went to 35. And I said, okay, well, the damage is done. I'm holding. Why sell now? And it went to 30 before it rebounded back to 40. I got out at 39 and change. Now I'm getting back in, being that it's, pushed down to 35 and even a little bit below 35 in the last few days. But something cheap can get even cheaper. No matter how long you play this game, you can always learn a new lesson. If something is cheap, super cheap, you say, I'll buy it, it's cheap. It can get cheaper. It can get cheaper. But if you're comfortable with the dividend and you're comfortable, holding through the cycle, these are cyclical downturns. These are not structural changes. There is no existential threat to these banks that they're going away. No matter what the cryptos and the DeFis want to tell you, the banks will eventually own that. I'm reminded of the 1990s when you had all these ISPs showing up. And in the city that I was in, I think there were like 4 or 5 ISPs, internet service providers. So they're companies that you could get your internet service from. And these companies would then go to Bell and buy big blocks of bandwidth from Bell. And at that time, I was given the opportunity to invest in one of these little internet service providers. And I listened to the whole pitch, and I had a location. They said, we can use your back room, and here's what happens. We put a bunch of modems on the wall, and we sell this much for this month, and we buy this much bandwidth from Bell, and this is the cash flows. And I thought, okay, so what happens when all of this is really successful and Bell says we don't need you anymore, and Bell decides to compete with you? What do you do then? Oh, that'll never happen. That'll never happen. The telcos can't move as fast as we can. They didn't see this coming. They're late to the game. They don't have the infrastructure for blah, 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 blah. Now when you need internet, who do you call? You call your cable company or you call your phone company. That's it. So this idea of all these DeFi startups and all of these payment systems and all of that going on, oh, the banks are late, they don't have the infrastructure, they're not innovative enough, they're not. I've heard that story before, and I don't believe it. I just don't believe it. The idea that they can't simply buy up a whole bunch of these companies, that they're completely unaware of what's going on. This idea that new companies come in to destroy old companies, I would say the 1970s called, and they want their entrepreneurship argument back. It's not really the case today that dominant companies today can continue to be dominant because they have the resources and the power to buy up any of the smaller ones that come along, and I think the banks will just do the same thing. So, I'm reminded of all these internet service providers, and had I invested in one of those, it would have just went away very quickly, because Bell didn't buy any of those internet service providers. It just said, hey, you're using our phone lines anyways, we can do this stuff, and they did that stuff. All right, where are we here? Last one. BOC is expected to slow down, deviate from the Fed on rate hikes, with consensus at 4% interest rate by year end versus 4.5 for the US. Do you believe this will further weaken the loonie versus the dollar going forward? Part of the relationship between two currencies could be interest rate differentials. It can also be inflation rate differentials, but it could also be growth differentials as well. So there is more than just an interest rate differential between the two. We tend to think, well, if you have an interest rate differential, all other risk premiums are built upon that interest rate, so all risk premiums will be in line with that. But that's not always the case. Right now, it seems like it's driven by an interest rate differential. But are we going to stop at 4, and are they going to go as high as 4.5? I think they're going to hit resistance very soon. I think they'll get to 4. I think they might squeeze out 4.25, but 4.5, I think it would be political suicide for Powell. I think that would the Democrats especially, I think, would start to call for his removal. So I don't know that they can actually get it to 4.5. I see 4 as probably 4.25 perhaps. I see a 50 and a 25 coming November and December. BOC 4% is probably probably right. The strength of the Canadian dollar can be driven by something more than the market coming to conclude that no, Canada will have the advantage in interest rates. We don't necessarily need the advantage in interest rates. You could just have an advantage in a different risk premium, such as economic growth. So with the transition to EV in the car fleet all over the world, and with a transition to a carbonless energy grid, you're going to need materials, and lots of materials, of which Canada has. Benchmark Minerals Intelligence forecasts that by 2035 the world is going to need another 384 mines. And if recycling can get to a decent enough level, 336 mines. Well, Canada has all that stuff. Canada has lithium. It just doesn't have the infrastructure built out. Well, that's foreign direct investment. So if you need that stuff, you got to go where the stuff is. You can't outsource a lithium mine to India. I mean, that doesn't work. So if that comes into play, you can have an interest rate differential where the U.S. has a significant advantage over Canada on the interest rate. But that if you're saying, well, materials are going to be a focus and energy is going to be a focus for a while, traditional energy, because you're going to need a transition fuel while you build out all these materials. Canada is overweight those on its index. If you buy the TSX, you're heavy into materials and energy. I think some 50%, 60% of the index comes from just that alone. So you can have a currency that is strengthening because one of its risk premiums are advantageous, even if you have a disadvantageous risk-free rate, because the premium for a particular market is made up of the risk-free rate, plus you're going to have some premium for credit. Then you're going to have some equity risk premium when you get into equities. And then when you're talking about foreign direct investment, you're going to have some liquidity premium because that is illiquid as well. So the sum of all these premiums in Canada could outweigh all of the sum of those premiums in the U.S. market. And that would add strength to the Canadian dollar. So it's not just one risk premium. Well, this is not a risk premium. It's not just one premium in the sense of we wouldn't even call it a premium. It's not one interest rate differential or one differential in terms of rates. What are your thoughts on taking a long position in SQQQ? Tech, as you mentioned, is usually the most affected by market downturns, and the ETF can be an alternative to taking an option position. Considering where we are, I'm less likely, sitting at 3,600 on the index, I'm less likely to take short positions at this point in time. I'm more likely to reduce my short positions, reduce the calls that I've sold, and start adding to longer positions here because I anticipate the next cycle. This sell-off, maybe there's more to it, but there's certainly not another 25%. So I don't know that I'm so willing to protect myself from the downside. I think risks are skewed to the upside at this point where equity markets are over the next quarter, because we do have earnings and I think they're going to be good. You do have rising employment, and you can't have a recession when you have rising employment. Because when you have rising employment, you have rising aggregate incomes, and given a consistent or a constant marginal propensity to consume, that money gets spent. The malls are still busy as hell. So I think that earnings will give a lift to the market. I think the growing government backlash against central banks destroying the economy to fix inflation is, that tension's going to have to resolve itself somewhere. I'm less likely to be short now than I was in the beginning of August. In the beginning of August, it was a no-brainer to be short. Now, if we rally now to 4,100 points over the next 7 weeks, then yeah, I'm more likely to start taking short positions at that point. But I don't want to take short positions after a significant sell-off like we've had from, what did we go from 4,300 in the last week of August? We're down to 3,600 right now, 700 points down. So I wouldn't do it. I myself wouldn't do it at this point. Anyways, that's it for this week. That was a long one, huh?